I know it sounds like a, a broken record when you see on social media, you see everybody, me including, telling you that the short squeeze is very close. The short squeeze is about to happen. Everything looks good. Things have not changed. And I know it's difficult to kind of visualize that when you see the share price tanking for the last 40, 50 days. Every single day, it's a conflict between what you are seeing on your portfolio and what people are telling you about exactly what to expect or what to see. So it has been kind of the story of the stock market since January, all right? And we'll be talking about that many times now. But I want you to show you exactly why when people say the short squeeze in AMC, it's closed, it's not about a time frame. It's about what is supposed to trigger it is actually getting closer by the day. Why? Because what we know so far wasn't what we knew in November, for example, or what we knew in November, it's getting even exaggerated. It's getting to the point where it's at the brink of happening. And I guess that's why Lou, for example, is saying that according to his books, AMC is done and he's moving on. He's moving to something else. He's looking at the life after AMC. So let me share with you something really, really interesting. Really, really interesting because, again, despite what you're seeing here, all right, stock price is dipping. Every single day it's red. Every single day is red. But here is the reality, because you shouldn't focus on what is happening here, because this price action, this line, it doesn't make sense because it's totally disconnected from what is happening behind the scenes. Because when you pay attention to what the money is flowing, to what is happening behind the scenes that nobody is talking about, that's exactly the reality of things, especially with AMC stock. So look, we have growth hedge fund. Growth hedge funds suffer worst rout in years. And this is what happens in December and in January. Look, stock market sell-off January dealt double-digit losses to a range of hedge funds investing in technology and other fast-growing companies. Whale Rocket, for example, Whale Rock Capital Management lost 15.9% for the month in the share class that invests in public and private companies, following a 9% loss last year, according to a person familiar with the firm. It doesn't stop there. Look, Tiger Global Management lost 15% for the month, another person said. It doesn't stop there. It's getting really more interesting. Melvin Capital Management, which we talked about a lot, and Light Street Capital Management both lost 15% following double-digit losses in 2021. Clients said. So the clients are not happy, right? Other hedge funds that similarly have bet markets will continue to reward fast-growing companies, including London-based Pelham Capital and Attica Capital Management in New York, also lost in double digits in January, investors said. Whale Rock Capital, this is the exact same fund that lost $13 billion after getting slammed in December. So not only they were losing a ton of money in December, but January just was, it was the to cherish on the cake when it comes to the losses. So clients are definitely not happy, because the reason why you go to hedge funds to invest, to get your money invested, is to get those numbers, those returns, those performances, but in types of gains, not losses. So it's messed up. It's messed up. It's messed up for them, because what used to sustain such an amount of gains in 2020 and 2019, and in 2020 especially, was the fact that everybody was seeing lockdowns as a reason to get invested and aggressive into the growth stocks, the futuristic companies, all right? But that was also sustained and fueled by the Fed. Easy money. Money was so cheap that it was easier to double down on those stocks. Those were getting higher and higher, and you need to go in debt, because the more you pay, the more you invested, the more you gained. But things are changing now, especially as interest rates are supposed to go up. Now, the thing is, hedge funds that piled into shares of fast-growing public and private companies in recent years have been richly rewarded against a backdrop of easy money and low interest rates. That was what I was just saying. If you look at Melanin Capital, for example, all right, in the month of ending 2021, they had 35% loss. Tiger, who also lost $25 billion at the start of 2021, wrote that companies in our portfolio generally continue to perform well and grow at rapid rates. At the same time, many of the stock prices have declined considerably, resulting in lower valuations today than we have observed in recent history. So they are all caught up in an environment, in a market that they never had to deal with before. So it has to do first with this, the Fed reacting, but how does it translate with AMC? Well, bunch of these hedge funds used to make a lot of money to justify the performance, to justify and maintaining clients based off of investing into technology, into growth. But now, I mean, have you seen the NASDAQ lately? The NASDAQ dropped almost 4% today. Almost 4% today. It's true that, stocks like Amazon, Snapchat, Pinterest are probably going to outperform the market tomorrow and we can see a quick rebound. But the reality is, bunch of these hedge funds are on the brink of either switching like Melvin Capital did. I mean, he lost so much money that he, even after being bailed out by Citadel Securities, the guy had to still raise money in order to go switch a new fund, change the name because he's changing its entire strategy. Why? Because it doesn't make sense. So on top of valuations, when these prices of these stocks go down, it means they are losing money, also meaning that it's going to be tough to do the exact same thing. All right. So they are not short selling anymore because it's dangerous. It's dangerous with what interests are going to look like, but it's also dangerous because you don't know what the market is going to do. You don't know what the market is going to react, especially since 2022 started. Today it's up, tomorrow it's down. The next step is either those who are in AMC are going to say, you know what, I probably need to get out now because otherwise I'm going to minimize my losses. Because if I continue to wait alongside the biggest guys, at the top, I may be in big trouble exactly like these guys. So that's why we say it's getting more closer to hedge funds being forced to get out of stocks like AMC because they are being crushed in other positions that are also losing money and putting them at the risk of losing clients. What are you? What kind of hedge funds are you if you lose clients? Not that much. These are not banks. So it's a tough job there. It's a tough market, a tough business to be a hedge fund nowadays. So we don't know exactly. I don't know. I cannot tell you when that will happen for AMC, but we are getting there. All right. It may not happen when we expect it to happen. And actually, I'm good with it because I want to wake up one day and see that, hey, it's happening.